afternoon. Happy Friday. This is Sean LaBelle of the Dekker Hewett group. It remained quite a volatile week here as global indices digested a little bit hotter than expected inflation data that came out on Wednesday. CPI came in with an 8.5% reading. The expectation had been for 8.3. So that news on Wednesday unsettled markets a little bit as it once again confirmed that inflation is still running quite hot. And this would mean that the U.S. Federal Reserve would likely have to remain on track for its more of a hawkish pivot, likely looking at a 50 basis point rate hike at the next two meetings. This probably taking us out until August. So markets this week were quite volatile to my earlier point, and in this week's Market Watch Weekly, we run through a little bit of the historical trading data as it relates to the correction that we've seen so far this year. There's a really good table in there that just illustrates where we have been in prior corrections up to 91 trading days in a year. Right now, believe it or not, this is the second worst start to a year in market history. You've got to go all the way back to 1932 to see a worse 91 trading days into a year. So there's a really good takeaway from that chart, though, and it is the performance of the market following those initial 91 days. And more often than not, you do see a large portion of those losses recouped. There have been some instances where the balance of the year was actually a net positive for the market as a whole. So we encourage you guys to take a look at that table. There's also a bit of added commentary in there as far as what timing the market generally means for investors, something we never encourage anyone to do. As you see in today's market, these sort of rallies are very unpredictable. Yesterday in the early morning, sentiment was very low. There was no sort of positive catalyst on the horizon. And yet today, here we are seeing major indices up between 2 and 4%. So there's a really good stat in there that just looks at what happens to investors that miss out on these types of days. You miss out on a couple and your yearly returns generally go from 9% to negative 4.5%. And this is what we mean by investors shouldn't really be timing the market. It's about time in the market. You always want to ride these sort of waves, and historical data does back that up. So we encourage you guys to have a read of this week's Market Watch Weekly. Hope everyone enjoys the weekend, and we will talk to you again next week. Cheers.